So coming to the discussion of second chapter, which is related to monetary and financial sector developments. So if you look at India's monetary policy system and financial sectors especially, it has shown a resilience despite global headwinds and growth in the first 9 months of financial year 2025. The Reserve Bank of India has maintained a stable monetary policy while focusing on financial inclusion and banking stability. Here, the RBI's role is nothing but focusing on financial inclusion and at the same time banking stability. So banking are very backbone to the financial system of any country. So obviously the role would be on RBI. The banking sector has witnessed a robust credit growth, improved asset quality and increased profitability because of gross NPAs have been declined. If you take for the last 10 years, especially scheduled commercial banks from public sector, the NPAs have been consistently declined. So obviously the profitability of banks would be very high, and at the same time asset quality. Earlier cases, asset liability mismatches. Because of these factors, the banking's profitability have been hit. But because of various tools, especially AI tools, the asset quality have been improved so that the banks have getting a profits. And robust credit growth. The banks are getting deposits, right? Because of these deposits, whenever the bank is getting higher deposits, obviously the credit expansion in the economy will also be very high. When credit expansion is very high, there is a high probability that banks are getting profits. So if you look at monetary developments in India especially, what are the monetary policy trends? The first one is stable policy rate. The RBI maintained the repo rate at 6.5% until December 2024. Till December 2024, the RBI has mandated and maintained repo rate at 6.5 and shifted its stance from withdrawal accommodation to neutral. So these are the monetary policy stances. CRR reduction, cash reserve reduction. So what happened if CRR reduced? When CRR has been reduced, obviously banks have more money supply. So when banks have more money, obviously it will lend to the companies and individual borrowers also. So the credit creation would be very high. The RBI reduced CRR from 4.5 to 4%, and at the same time which injected a 1.16 lakh crore into the banking system, which was the report released by December 2024 RBI press release. And when it comes to money supply growth, the broad money supply especially, which was measured under M3, which grew at 9.3% year on year as of December 2024, which was lower than 11% last year. That is also mentioned under RBI weekly statistical supplement, which was published in January 2025. When it comes to inflation and liquidity trends, inflation management, CPI inflation remained within 4 to 6% range. That's what Monetary Policy Committee, and at the same time Government of India has come up with a initiative, flexible inflation targeting under 2016 agreement. So obviously the CPI has in between the 4% plus or minus 2, that is 4 to 6%, averaging 5.4% in financial year 2025. So on an average, the inflation rate in the economy is 5.4%. When it comes to money multiplier, it has been increased to 5.7% in December 2024, which indicate a higher liquidity in the system. That is RBI data based on Indian economy January 2025. And what are the challenges in monetary policy? The first one is global interest rate trends. The US Fed and European commercial banks' high interest rate regime may lead to capital outflows from India, affecting rupee stability. So how it will work? Let's take an example. So there are two types of investments. One is FDI and second one is FPI. So majority of the companies, what they will do? They will simply invest in FPIs, foreign portfolio investment. Nothing but your stocks or debt instruments. So obviously India is giving a high interest rates. That's why majority of the countries or majority of the investors are looking forward to invest in India. So that's the case. Let's suppose if US Federal or European Central Banks have increased interest rates, then obviously all of a sudden these capital, whatever they have been kept in Indian stock markets, they will simply take away their capital and they will invest in USA or European Union. That is capital flight risk. During these phases, obviously the currency of Indian rupee will be depreciated also. That's where the currency stability also comes into the issue. Liquidity management. Excess liquidity could fuel inflation, requiring careful balancing of growth and price stability. So obviously when liquidity is very high in the economy, nothing but in our simple language, money supply. When money supply is very high, obviously the interest rates to take loans from these is also very less. So when interest component is very less, then obviously people are very encouraged to take loans. So obviously people have more money in their hands. The purchasing power of people would be very high. When purchasing power is very high, inflation is also comes into the picture. So at that time the government and at the same time RBI wants to maintain that economic growth and at the same time price stability should go hand in hand. Next, performance of financial intermediaries. So each and every financial intermediary, whether it is in the form of banks, insurance companies. So what are their positives and negatives? That is the discussion. So if you look at banking sector, bank credit growth, which was moderated to 11.8% in November 2024 from 15.2% in 2023, aligning with deposit growth, which is RBI sectoral deployment of bank credit. That is the report. Declining NPS. Gross NPS of scheduled commercial banks fell to 2.6% in 2024, which is lowest in last 12 years. So right now 2.6% is the NPS, gross NPS of public sector banks. So when these gross NPS have been consistently reduced, then obviously banks profitability will also increase. Next one, improved capital buffers. Capital to risk weighted assets CRAR of scheduled commercial banks stood at 16.7% in September 2024, well above Basel III norms. Basel III norms 9% and 12%. That was the norm given under Basel III norms. But if you look at this banking sector performance, the CRAR ratio is also 16.7%, which is very higher than Basel III norms. If you look at this chart, declaring in GNP of scheduled commercial banks, CRAR well above the required norms. So March from 2015 onwards, the CRAR has been consistently increased. That means the reserves required to absorb any losses in the banking system would be very high. If you look at GNPS as percentage of gross advances from March 4.3% in 2015 to 2.6% in September 2025, which was data taken from RBI Financial Stability Report. And what were the negatives? Rising unsecured loans. What is unsecured loan? Without any collateral, if you take any loans, that means that is unsecured loan. Just like your credit cards. So consumer credit. So because of financial inclusion and digital penetration of internet, by using apps, obviously you are getting credit. So consumer credit has been increased, which include personal loans and credit cards, which were grew by 25.2%, which rising financial stability concerns. These are unsecured loans. Obviously, the lender, whoever giving the loans in the form of loans or credit cards, let's suppose if they are defaulting in future, then the financial stability concerns would arise in the SEC. So that is the data from RBI November 2024. And if you look at the declining net interest margins, which has increased cost of funds lent to marginal decline across all the banks. The net interest margins from especially public sector banks to increase cost of funds, which has decreased all the banks. Slowdown in MSME lending. Credit to MSME grew at 13% year on year, lower than previous years due to high risk weights on NBFC lendings, because majority of the loans were from NBFC sectors, but government, especially RBI, has kept some controls under the RBI's NBFC lending practices. Because of these lending practices restriction, the credit to MSME sectors have been consistently declined also. Under rural financial institutions, which was data from regional rural banks. Regional rural banks, the coverage extended to 696 districts and 22,069 branches and 313.3 crore deposit accounts, which was data released by NABARD from 2024. Higher credit deposit ratio increased from 67.5% to 71.2% in the highest last 33 years. CD ratio, credit to deposit ratio have been increased. That is a good sign according to NABARD data. And when it comes to negatives, persisting NPAs, here the problem arising is nothing but your non-performing assets, especially under scheduled commercial banks, even for that matter even regional rural banks also. So despite improvement in GNPA, the ratios for RRBS remains high at 6.1% in financial year 2024, which affecting the profitability. So despite improvements, already it was at 2.6% as of now for this financial year. But RRBs have been playing with these high NPAs. Limited digital banking reaching. RRBs face challenges in adopting fintech solutions, especially financial services providing through technology, that is fintech solutions, which impacting financial inclusion. So obviously each and everyone should not include in this financial inclusion. So which is the data from financial inclusion of RBI report 2024. Limited digital banking reach. So digital banking reach is very poor, especially if you look at RRBS, regional rural banks. And next one is development financial institutions, DFIs. So infrastructure financing by IIFCL, which is sanctioned 2.8 crore for highway, energy and port projects, which was the report released in the 2024. And NAF bid impact, which approved loans worth 1.3 lakh crores for renewable energy, transport and social infrastructure. That is also from RBI data. And the negatives, funding constraints. Obviously these DFIs struggle to raise long-term funds at competitive rates. Competitive rates here are nothing but your interest rates. So majority of the times the government is taking loans, right? And sometimes even banks or other financial institutions, so they are taking risk aversion techniques by not giving credit to these DFIs. So when there is less scope for lending at competitive prices, obviously the long-term funds required for these DFIs will be also problem. Execution delays. Slow disbursement hinders the effectiveness of infrastructure financing. The financing, generally if you look at infrastructure, it will take a long gestation periods. So at the right time, you need a finance. Let's suppose if these finances are not reached right time, then obviously the project cost would increase. That is also one of the problem for execution of DAs. And cross-country comparison of bank credit to private non-financial sector as percentage of GDP. If you look at map, China 200.8% of their GDP. That is bank credit to private non-financial as percentage of their country's GDP. That is the highest one. Next one Malaysia at 120.8. Next Japan. Next Thailand and UK, Brazil, South Africa and India at 56.6. So you can expect some type of questions. Under cross-country comparison or non-financial sector as percentage of GDP, India was placed under which rank? Or let's suppose if they are giving 4 options. So from higher to lower or lower to higher, they can be frame a question. So this was the data from Bank for International Settlements. And when it comes to artificial intelligence in banking, AI adoption in banking. So let's suppose if we take some cases, AI is widely used for credit risk assessment, whether borrower past history in financial sectors. This will be done through AI models, so that the credit risk assessment will be done and fraud detection and chatbots for customer service, which was the PwC India report, PricewaterhouseCoopers India report 2024. AI-driven lending, digital lending platforms use machine learning models for credit underwriting, enhancing financial inclusion. And next one is challenges in AI adoption, data privacy risk. AI-driven models raise concerns about data security and algorithmic biases. So because of algorithmic biases, sometimes inclusion and exclusion will also be a problem. And at the same time, data security, whether your data is really safe or not, that is also one of the problem with AI. Cyber security threats, increased AI-driven fraud and deep fake risk in digital banking especially. So that was a report released by RBI Cyber Security Report. Regulatory gaps, lack of comprehensive AI regulation framework for the financial sector. So there is no comprehensive AI regulation for the regulatory gaps in India's banking system. Hiroshima AI Policy Framework 2023, if you take an example. And what is the efficacy of insolvency and bankruptcy code? The success of IBC is in the form of faster resolutions. 1068 resolution plans approved, recovering 3.6 lakh crore, which is 161% of liquidation value. Insolvency Bankruptcy Board of India 2024. That is the success rate. Reduction in NPS, major corporate debt resolution led to a decline in stressed assets in the banking sector. When these reduction in NPS have been gradually declined, obviously the banks are getting their principal and interest amount. Then these banks will turn into the profitable business. Improved investor confidence, corporate bond yields have declined post IBC, boosting capital market participation. That is IGIDR report. What are the challenges in IBC implementation? Delays in resolution. The average time for resolution is 582 days, far above the statutory limit for 330 days. So this was the statutory limit set up by government under the Supreme Court guidelines. But on an average, it has been taking 582 days to resolve the issues. That is NCLT report 2024. Haircuts for creditors. Creditors face 69% haircuts on average, affecting financial recovery. The full recovery does not happen because of these haircuts. 69% of their money was under the haircuts. 2024 and 25 economic survey. Tribunals overload. 2593 cases pending at NCLT, leading to slower resolution. So the tribunals cases were pending. When it comes to capital market, the development of capital markets, growth in the investor participation. Investor base in Indian stock market increased from 4.9 crores in financial year 2020 to 13.2% as of December 2024. That is the source, SEBI. Next one is IPO surge, initial public offering. India accounted for 30% of global IPO listings in 2024, which is from 17% in 2023. So gradually the IPO rate has been increased, which is leading in primary resource mobilization to raise the money, especially the privately held companies going for IPOs to raise the money. That is nothing but their primary resource mobilization. According to MSI Global IPO Trends, that is the report. Market capitalization milestone. Total market capitalization of BSE listed stocks crossed $5 trillion in May itself. Nothing but what is market capitalization? Total shares in the market into present market value. That is the market capitalization. That has been already reached $5 trillion. Debt market growth. Corporate bond issuance reached 7.3 lakh crore, which is in April to December 2024, but still lag at 18% of GDP compared to 80% in Korea and 36% in China, according to SEBI annual bulletin. Next one is retail investors share in market. Retail investors participation increased significantly, accounting for 35.6% total market turnover. This was happened because of RBI's retailed edged securities accounts. So in earlier cases, banks and other financial institutions are participating in these share markets. But after 2020 onwards, the RBI has come up with a new initiative. So just like you as a single person, you can invest in government markets, bonds. That's why 35.6% of total market turnover was in 2024. Rise in SIPs and mutual fund participation. Surge in SIP accounts. Over 10 crore SIP accounts with total SIP inflows reaching 10.9 lakh crore since inception. Association of Mutual Funds India. Mutual fund AUM growth. Mutual funds assets under management grew 25.3% March to December 2024, reaching 66.9 lakh crore. And at the same time, retail investor share. Unique mutual fund investor doubled the 2.9 crore in financial year to 5.6 crore in financial year 2024, which boosting financialization of household savings. This is also where one of the problem arises, where excessive financialization of capital markets. The household savings, what are the household savings that are completely invested into these stock markets? That is also not a good sign for developing economies like India. Next one, Gift City, India's international financial hub. It has 720 entities established at Gift City with IFSC ranking 52nd globally and 45th in fintech rankings according to Global Financial Centers Index. Banking expansion under Gift City. IBFC banking units assets crossed already $70 billion with credit exposure over $51 billion in September 2024. Next one is fund management growth. Alternative investment funds which were regulated by SEBI rise $12.1 billion, boosting India's alternative investment sector. Next one, insurance sector development. Insurance premium growth. The total insurance premium reached 11.2 lakh crore in financial year 2024 with life insurance at 8.3 lakh crore and non-life at 2.9 lakh crore. This is also significantly very small number because of premiums. Whatever we are paying for insurance companies, It is inclusive of GST, 18% of GST, right? So during last 1 year, the government under GST Council has constituted a group of ministers to take the decision about insurance premium rates, especially GST rates. Decline in insurance penetration dropped to 3.7% in financial year 2024, below the global average of 7%, according to Swiss Re Institute. Projected growth: India's insurance market is expected to grow at 11.1%, becoming the fastest growing G20 insurance markets, according to the data from G20 2024-28. Next one, pension sector, pay as you go. Nothing but growth in pension subscribers. National pension system and Atal pension system subscribers rose to 783.4 lakhs in September, which is 16% year on year, according to data from Pension Fund Regulatory Development Authority of India. API dominance, Atal Pension Yojana. API accounts for 80.3% of total pension subscribers, but 93.7% accounts are 1000 rupees for month pension, reflecting income constraints. Next one, introduction of unified scheme. UPS offers 50% last dance salary as pension with minimum 10,000 month per pension for government employees. And if you look at the international pension crisis, what are the lessons that you should learn for India? Japan, which is aging population, which led to public pension fund depletion, obviously, which requiring increasing retirement age and a higher worker contribution. So that is the Japan case. If you look at the Greece, generous pay-go pension led to unsustainable public debt, forcing severe austerity measures post 2008 financial crisis, according to IMF. Next one, UK, underfunded pension schemes led to crisis, prompting regulatory interventions to increase corporate pension contributions, according to Source Financial. Key lessons for India: scaling pension coverage via sustainable contributory schemes like NPS and API while avoiding unfunded pay-go risk. Here you should not go for pay-go risk. Next one is regulatory impact assessment and governance. What is the need for regulatory impact assessment? Which ensures quality regulations via systematic and cost-benefit analysis. That is the requirement under RIA, according to OECD 2008 guidelines. What about the global adoption? By 2016, 32 out of 35 OECD nations had RIA frameworks. That is the source from Deloitte Smith A 2006. Indian financial regulators and RIA practice. In India, are we really following these RIA guidelines? Under IBVA, it requires economic impact analysis and periodic review of regulations. Under SEBI, which conducts stakeholder consultations but lacks mandatory RIA framework. And what are the recommendations? Recommendations would be independent RIA unit, each regulator to assess economic and social cost of regulations. That is the Indian financial regulators and RIA practices. Next one is cyber security in India's financial sector. Rising cyber attacks. India facing 13.9 lakh cyber incidents in 2022, with financial institutions among the top targets, according to data from SET-IN. Financial losses due to cyber threats. Cyber attack related losses in financial services subject to US $2.5 billion globally in 2024, which is IMF Global Financial Stability Report. India's cyber security ranking, it has ranked Tier 1 globally in 2024, scoring 98.49% in Global Cyber Security Index. These indexes under the same time, the reports, whatever the reports released by different international institutions, so these were very key for your prelims point of view. And what are the regulatory measures? RBI has cyber security audits for banks, new IT outsourcing regulations. By having these measures, RBI is regulating these areas, and SEBI and PFRDA stricter norms for financial market cyber security. These bodies are also having these norms. Risk to financial sector, especially India's over reliance on global markets, especially a major correction in the US stock market. 75% of MSCI World Index could impact India's markets if you overly rely on global markets for your investments especially. Retail investor at risk. Young investors dominate 40% of the NSE accounts. Many lacking experience in downturns. That is NSE report. Next one is corporate bond market weakness. High dependence on AA rated bonds. 97%, which limits access for small players and reducing market liquidity. And next one is financial development versus economic growth. A balancing act need to be done. Here the optimal finance versus over finance. Countries like Ireland and Japan saw excess credit to GDP ratios. Credit to GDP ratio. The credit is over than their GDP. Then obviously the economic growth will affect. That is also which stifles the growth according to BIS research 2015. Thailand reduced private credit during Asian crisis, which boosting the productivity growth. So these are, one is optimal finance case and second one is over finance. And if you look at India's financialization growth, the bank credit share declined from 77% in financial year 11 to 58% in financial year 2022, which is showing a shift market based financing. RBI Handbook of Statistics. Increase in equity based financing with IPO listings growing 6 times since financial year 13. What is the way forward for India? Expand debt markets, reduce over reliance on bank credit by improving bond market liquidity. You should not focus only on bank rate, rather than you should focus on bond market and liquidity conditions in bond market, so that you have a greater access to all stakeholders. Enhance financial literacy, prevent overexposure to retail investors to high risk assets. So the financial literacy is very good, but at the same time you should be very cautious about overexposure to retail investors, especially high risk assets. Strengthen cyber security frameworks, prevent systematic risk in digital financial transactions. Adapt regulatory impact assessment, ensure cost effective and inclusive regulations especially. And pension system reforms, expand NPS and API coverage while avoiding unfunded pay-go liabilities. Here only the pay-go liabilities would be avoided when it was unfunded. Next one is avoid over financialization. Regulate speculative financial products to prevent asset bubbles. That's what we are discussing. Especially household savings are especially moved to bond markets. That is excessive capitalization. And when it comes to conclusion of this chapter, India's monetary and financial system has a strong resilience and adaptability in 25. The banking sector's health has improved, especially with respect to NPAs. Financial inclusion has expanded obviously because of Government of India and RBI initiatives for the financial inclusion. And AI adoption is transforming banking operations altogether. However, rising unsecured lending, gaps in AI regulation and delays in IB resolution which pose key risk. Moving forward, policy focus should be focus on strengthening financial regulation, improving DFI efficiency and fast tracking IBC cases to sustain economic stability and growth. So here India's monetary policy and at the same time financial systems are showing a strong resilience because of banking sector's health and at the same time adoption of AI and financial inclusion. But there are some cavities like delays in IB and financial regulations of DFI and at the same time fast tracking of IBC cases to sustain economic stability and growth. If you focus on these areas, then obviously the economic stability and growth of India's economy would be very resilient. So that is the discussion for this chapter. So coming to the discussion of third chapter, which is related to external sector, mostly focusing on FDI, right? Whether getting FDI is correct or not for any economy. So most of the times any country is required to get FDIs. Why? Especially for developing nations. Because in developing nations, most of the times the countries, governments does not have enough resources, especially financial resources to build their nations. So obviously these FDI will pull up these efforts. So that's why FDI is very important. If you look at India's case, India's external sector has demonstrated a resilience despite global headwinds because of different types of global geopolitical risk. The India's external sector has demonstrated a resilience, including geopolitical conflicts, supply chain disruptions, and rising protectionism, which is nothing but deglobalization. In globalization era, most of the times the countries are connecting through trade, investment, services. But what about the protectionism policies? So only the countries are focusing on their manufacturing facilities within their borders. The total exports, especially from merchandise and services, reached to $602.6 billion in the first 9 months of financial year 2025, reflecting 6% growth, while imports rose by 6.9% to $682.6 billion. That's why if you look at India's external economy, most of the times we are very happy that our services are getting paid. But at the same time, the imports to India is also very high. That is the biggest problem. That's where your balance of trade or payments issues will arise with one or another nations. So if you look at global trade dynamics, global trade faces multiple disruptions, including Russia-Ukraine war, Red Sea tensions, US-China trade restrictions, and supply chain reconfigurations after COVID-19. Whether it should be China plus one strategy or supply chain resilience initiative or build back better world. So these were some of the areas where the most of the countries are focusing to shift their supply chains because of disruptions caused by COVID-19. And at the same time, rising geo-economic fragmentation due to increased friendshoring and nearshoring strategies. These are some of the strategies adopted by some of the companies, especially if there have been any risk associated with some of the nations, then friendshoring and nearshoring will be the strategies for any nations according to UNCTAD. So if you look at friendshoring, which is nothing but relocating supply chains to manufacturing to politically allied or geopolitically friendly countries. Nothing but if you look at India and USA. So majority of the time the rivalry would be China, right? So in future the United States is shifting semiconductor production from China to India and Vietnam because USA, India and Vietnam are politically allied countries or geopolitically friendly nations. So that's what friendshoring. And nearshoring is nothing but near to that countries. It involves moving production and supply chains closer to the home country. Here, reduce transportation cost, that is the goal. Improve logistics and enhance the supply chain resilience, that is the major goal. So if you take an example of European Union companies shifting production from Asia to Eastern Europe or Mexico. Well, if you move these from Asia to Eastern Europe, obviously the transportation cost will be reduced and improve logistics. Logistics cost will also be reduced and supply chain resilience will also be very effective if in case any pandemic will arise in future. And tariff and non-tariff measures have been rising, reshaping trade flows with increasing export restrictions and environmental regulations like carbon border adjustment management tax, which was proposed by European Union, and at the same time UUDR, that is according to WTO 2024. Let's suppose if you take global trade performance in 2024, global merchandise trade, which is showed a 3.5% year-on-year growth in quarter 3 2024, while services trade expanded by 7.9% according to UNCTAD. If you look at these numbers, majority of the times the service sectors contribution will be very high, but at the same time the merchandise trade, whether it should be positive or negative, but you need to keep in mind that our service export potential is very huge to different countries. Developed economies outperformed emerging markets, reversing previous trends. So here the developed economies, let's suppose USA, UK, these are outperformed than emerging markets, which replaced the previous trends. And what was the projected global trade growth? 3.3% in 2024, which was reaching $33 trillion, which led by growth in service exports. So here the keywords are service based exports is the future. UNCTAD Now Cash 2024 report. Tariff policies and their role in industrial policy. Tariff reductions have been a global trend. Yet selective tariff reductions have driven industrial growth. So according to WTO, tariff should be gradually reduced. Nothing but taxation. Tariff is nothing but tax. Despite being a global trend, tariff reduction, still some selective tariff reductions have driven industrial growth, whether in the positive or negative way. So if you look at India and USA case, reciprocal tariffs. Because of these reciprocal tariffs, obviously the industrial growth will be affected. In India reduced average tariffs from 48.939 in 2002, 17.3% in 2024. While China's tariffs declined from 16.4% to 8.3%. That is according to WTO. The strategic use of tariffs, as seen in South Korea's industrial policy in 1970s and US protectionism 19th century, which helped domestic industries because of using these tariffs as a strategic tool or weaponization of economy by using tariffs. In South Korea under their industrial policy in 1970s and USA under its protectionism policies, especially in 19th century, which helped to nurture their domestic industries. That is the tariff policies and their role in industrial policy. How tariff policy boosts industrialization? In fact, industry production. Nothing but tariffs shield emerging sectors until they achieve global competitiveness. Nothing but in the initial stages of the companies, obviously these companies are not getting any tariffs. So obviously they will rise. After once they are getting into the global competitive markets, then there is a problem of tariffs. Encouraging local value addition, reducing tariffs on raw materials while increasing duties on finished goods, promote domestic manufacturing. Here, by reducing tariffs on raw materials. So obviously when raw materials taxation was very low, the domestic manufacturing facility, especially value addition, will be very high. And at the same time, if you increase duties on finished goods, if you increase duty on finished goods, especially when they are importing into India, then obviously the domestic manufacturing companies will try to manufacture those products, especially in India itself. That's why it will be encouraged for local value addition. Preventing dumping. Tariffs help curb unfair trade practices by countries with excess production capacity. Example, China steel exports. Because China is producing steel and at the same time it is exporting to countries like India at a lower market than their domestic market value. Obviously, by using these tariffs or taxes, it will be preventing dumping. Non-tariff measures, nothing but a primary trade barrier which affecting 67% of global trade according to UNCTAD 2024. Technical barriers to trade and export related restrictions have increased and mostly climate focused NTMs like CBAM and UUDR impact emerging economies disproportionately. So far these countries have been benefited from climate change induced investments, but in reverse they are expecting to do more from emerging economies, especially India, China. That's where the problem arises whenever United Nations Framework Convention on Climate Change negotiations will happen. So if you look at carbon border adjustment management tax, that is nothing but it is an European Union mechanism which imposes a carbon tax on imports of carbon intensive goods, nothing but iron, steel, aluminium, fertilizers and cement. These are carbon intensive in nature. They are producing more carbon. The objective is to prevent carbon leakage by ensuring imported goods face the same carbon cost as EU domestic products. So let's suppose if you produce these goods in European Union itself, the same price will be paid for any importer if let's say they are importing from India. That is the major theme behind CBAM. How it will work? Reporting phase 2024 to 25, importers must declare embedded carbon emissions. How much carbon emissions they have been, obviously they have to report. That is the reporting phase. In implementation from 2026, certificates must be purchased to cover emissions. Next one, impact on India. 10.5% of India's EU exports, approximately US 7.4 billion are CBAM affected according to UNCTAD, and iron and steel exports and aluminum exports are most vulnerable. These are the major areas where this CBAM is affecting our export potential. Increased compliance cost for Indian exporters impacting price competitiveness. Obviously, when compliance cost for Indian exporters are very high, obviously these products, these industrial goods especially, these are not going to be anyway competitive in the rest of the world. That is also one of the problem. India should invest in green hydrogen, carbon capture and energy efficient manufacturing to mitigate CBAM risk. That is the way forward to achieve the CBAM strategy, to mitigate this strategy. Next one, European Union Deforestation Regulation, EUDR. It aims to ban imports of products linked to deforestation. By having deforestation, if any goods are exported from India, then obviously these goods will be banned. So if you take an example, coffee, palm oil, rubber, soya and wood, these are some of the goods which requires due diligence, compliance and supply chain traceability. And if you look at impact on India, India's exports of coffee, leather and paperboard are obviously US dollar 1.5 billion face risk. Stringent compliance cost and country specific deforestation rankings could disadvantage Indian producers. This is not related to only one country, right? If you look at different countries have different deforestation rankings. Obviously, the products which are going to hit these nations will also be affected. So obviously, the disadvantage for Indian producers will be very high. And what is the way forward? The sustainable certifications will be done. Reforestation programs should be conducted and supply chain transparency will be critical for India's exports. That is the way forward to overcome these two regulations. Next one is India's trade performance, financial year 2024. What is the trade performance of India especially? Exports performance. India's total exports reached $602.6 billion, which is showing a 6% growth despite global challenges. Non-petroleum, non-gems jewelry exports grew 10.4%, which reflecting diversification in export categories, especially non-petroleum, non-jewelry, gem and jewelry. Services exports increased by 11.6%, with IT and business services driving the sector's growth. And imports performance. If you look at imports performance, India's total imports amounted to $682.2 billion, which marking a 6.9% increase driven by domestic demand. So whenever imports are increasing, obviously our forex reserves will be depleted. So obviously we need to pay them in their currencies. So the forex reserves will be reduced. That's why you need to be very cautious about your imports, whether these are essential or non-essential. That you should have a clarity, right? Gold imports surge due to festive purchases and increased safe haven investments. Because of these two reasons, gold imports have been surged. Non-oil, non-gold imports increased, which indicate higher investments in capital and industrial goods. That is the regarding gold imports and non-oil imports. Next, coming to trade deficit. India's trade deficit widened US $79.5 billion from April to December due to faster import growth. So if you look at the textile exports data and market, India ranks 6th globally in textile exports. So these numbers are very important. Whether in which position India has been placed globally. With exports valued at US $34 billion in 2023, apparel exports contribute 42%, while cotton-based products dominate the export market. And also, if you look at market share, India's global apparel market share is 2.8, significantly lower than China. China is 30. Bangladesh is 9% and Vietnam is 7%. So, let's say if the examiner will frame a question based on the apparel market share value, if they have given options China, Bangladesh, Vietnam and India, from highest to lowest or lowest to highest, what is the contribution from India's perspective? So what are the different countries involved? That might be a potential question. So what are the challenges? High input cost and fragmented production increase the cost of textiles compared to competitors. So obviously to produce these textiles, first one is high input cost is one of the main barrier, and at the same time fragmented production. The complete textile is not producing at one place because of fragmentation of production process. The cost of textiles would be increased. When cost of textiles would be increased, the competitiveness of their competitors will be very high. Tariff disadvantages exist, such as the United States imposing 11.3% duties on Indian textiles, while Korea enjoys zero tariffs. So obviously, Korea textiles will dominate the US markets. Environmental compliance. Costs are increasing due to European Union sustainability regulations. Just now we have discussed. Government initiatives. What are the government initiatives? PLI scheme. PLI 1.0, PLI 2.0. These are some of the initiatives taken up by Government of India after COVID-19 under Atmanirbhar Bharat package. What is the purpose? With an allocation of 10,683 crore aims to boost man-made fiber and technical textiles. And PM Mitra Parks, which support integrated textile hubs to enhance efficiency and reduce production cost. Next one, rebate of state and central taxes and levy scheme extended until 2026, provide tax refunds on textile exports, which is nothing but RODTEP scheme, RODTEP scheme, which has been extended to 2026. What is the way ahead? Increase man-made fiber production to match global demand. The demand, whatever the demand, that should be supplied, right? According to demand, we need to supply. In a similar way, increase man-made fiber production. These are required in globally and improve India's competitiveness. Next one, simplify regulatory procedures to reduce bureaucratic delays and improve export efficiency. And when it comes to e-commerce exports, India's e-commerce exports stood at US $4.5 billion in financial year 2023, showing strong growth potential, and also it projected to reach 200 to 300 billions by 2030, which is driven by increased digital adoption and global demand. Because of digital adoption, and at the same time, the products are especially demanded in different countries. What are the challenges? Regulatory complexities in Foreign Exchange Management Act, FEMA, and goods and services tax compliance hinder smooth operations. Next, export courier value cap is limited to $12,000 US in India, while China allows 50,000 per shipment. Per shipment they have capped at US dollar $50,000. And government support, open market for digital commerce, ONDC, just like how your Flipkart and Amazon working. In a similar way, the government is promoting ONDC, which framework helps micro, small and medium enterprises enter global e-commerce markets. To enter into the global e-markets, this ONDC platform has been promoted by Government of India, especially for micro, small and medium enterprises. Bharat Mart in Dubai, which is facilitating Indian small and medium enterprises, which is reaching Middle Eastern and African markets. That is the government support. And ease of doing business initiatives for exporters especially. Electronic bank realization certificate system has reduced the compliance cost for 2.5 million transactions annually because of this electronic bank realization certificate. And the Directorate General of Foreign Trade and Trade Connect e-platform provides real-time market intelligence for exports, especially exporters. What are the real-time updates? Real-time market awareness, especially for the exporters. And rebate of state and central taxes and levy scheme, which is nothing but your ROD TEP scheme, extended till 2026 to enhance competitiveness of textile exports. And initiatives under Foreign Trade Policy 2023, Niryat Bandhu scheme, which is nothing but mostly focusing on capacity building, skill development and hand-holding support for few exporters if they have lacking. And market access initiative, which focuses on financial assistance to e-commerce exporters to expand their global reach, to present their market in global. This market access initiative scheme was introduced under financial assistance will be provided to e-commerce exporters especially. Export and packing credit, which focus mostly on collateral free low interest loans for pre-shipment and post-shipment export financing. Here the export financing will be provided in the form of collateral free. You should not be kept any documents, any properties, and low interest. Dak Niryat Kendra, which strengthen postal export infrastructure to help small exporters via India Post. To make India Post, especially for the small exporters, postal export infrastructure will be strengthened under Dak Niryat Kendra. Electronic Bank Realization Certificate (EBRC) enables digital verification of export transactions for easier compliances. The exporters who are exporting the goods from India, obviously their export transactions will be digitally verified under EBRC. Next one, balance of payments resilience amid challenges. India's balance of payments has remained resilient despite global economic uncertainties driven by strong services exports that you should keep in mind. FDI inflows and robust forex reserves. So these are the three areas where India has an advantage. One is service sector, second one is strong FDI inflows, and third one is robust forex reserves. Already we have more than $600 billion. The current account deficit has been contained while capital flows have exhibited a mixed trends due to global financial volatility. So if you look at current account deficit, it is moderated to 1.2% of GDP in Q2 financial year 2025 compared to 1.3% in financial year 2024. Merchandise trade deficit increased to $75.3 billion in Q2, $64.5 billion in Q2 financial year due to rising imports. Net services receipts grow from 39.9 billion to 44.5 billion in Q2 financial year 2025, which helping cushion CAD. And remittance inflows, when it comes to remittance inflows, private transfer receipts, especially remittances, increased $31.9 billion from $28.1 billion in financial year 2024. India remains the largest recipient of remittance. So sometimes Questions would be framed on World Bank remittance reports. With US dollar 125 billions in 2023 according to World Bank. Capital and financial accounts. Net capital inflows stood at US dollar 13.5, which is significantly up from US dollar 12.8. Inflows were supported by FDI. Most of the inflows are FDI. And external commercial borrowing, ECBs. And portfolio investments. These were the major reasons why inflows were very high in Indian economy. Next one is foreign direct investment performance. FDI inflows and outflows. Gross FDI inflows reaching $55.6 billion versus 47.2 billion in 2024. Net FDI stood at 0.48 billion in 25 year, which is lower than 8.5 billion in 2024 due to increased repatriation, getting back to their home countries. Cumulative FDI, especially from 2000 to 2024 for the last 24 years, it has crossed $1 trillion, which is strengthening India's position as a global investment hub. So if you look at repatriation or disinvestment and gross FDI flows from financial year 2022, April-November 2024. Next one is sectoral trends in FDIs. So what are the major areas where FDI is getting involved? So if you look at computer, software and hardware 14.1, trading 9.1, non-conventional energy 7, cement and gypsum products 6.1, construction activities 4.4, electricity energy 4.3, consultancy services 3.2, automobile 3.2, hospital and diagnostic centers 3.1. So it is very important. So you might expect questions from the trends. What are the different areas where the India is getting highest revenues in the form of FDI? That is from DPIT, which is under Ministry of Commerce and Industry. Next one is top FDI inflow destinations 2023 Global Bank performance of portfolio. FDI inflow slowed to $10.6 billion in April-December 2025, which is from 31.7 billion in financial year 24 due to global volatility. Because of global disruptions, the US foreign portfolio investments have been gradually reduced. FPI in debt market surged, driven by India's inclusion in JP Morgan Emerging Market Bond Index, according to NSDL SEBI. FPI in equities turned volatile because the dollars were reversed from US to India to US. Global bond market inclusion impact. Indian government bonds inclusion in global indices led to US $3 billion net inflows in financial year 2025. Because of Indian government bonds were placed under global indices. Because of this reason, FDIs have been increased. Assets under custody, fully accessible route securities reached $28 billion by December 24. And forex reserves and performance. India's forex reserves stood at 640.3 billion as of 2024, which covering 90% of India's external debt. On the spot, if you want to repay your debt obligations, obviously 90% of your debt obligations will be paid off. Forex reserves increased by $27.1 billion in 2024, which is driven by capital inflows and DOP surplus. India is ranked 4th globally in forex reserves after China, Japan and Switzerland. This is very important for prelims. And import cover improved to 10.9 months, which is surpassing IMF's 3-month threshold for emerging economies. For emerging economies like India and China and other nations, the threshold limit is only 3 months. But for India, it has already 10.9 months for import cover. Forex reserves ranking 2024, India's external debt position Nothing but what are the different types of debts that were taken by Indian government. India's total external debt at 71.8 billion as of September 2024 with a stable debt to GDP ratio of 19.4%. If this debt to GDP ratio has been increased, then the repayment obligations and interest components will also be very higher to pay back. Short-term external debt increased to 18.8% of total debt. Debt denominated in US dollars, $53.4 billion remains dominant, followed by INR, Indian rupees, and special drawing rights and euro. So this was the question already asked way back in UPSC prelims. So this type of questions, this type of analysis is very important to understand what are the different trends, especially India's external debt. And if you look at movements in foreign exchange reserves, this is the foreign currency assets, gold, reserve transposition of IMF and SDR, special drawing rights, and total. And comparison of debt levels. United States 31.4 trillion, China, Japan, India at 4th place. So what is the way ahead, especially under FDI? Strengthening external sector resilience, enhance export competitiveness by reducing trade cost. By reducing trade cost, you can enhance your export efficiency. And diversifying market, you should not focus only one market, rather than you should focus on diversifying different markets beyond traditional destinations. Next one, boost services trade, particularly IT and digital exports to mitigate merchandise trade deficits. Anyway, we are very expertise in service sectors. So why can't we focus on IT and digital exports so that it will have a negligible effects when it comes to merchandise trade deficits. Improving capital inflows, encourage FDI through tax stability, ease of doing business, and policy predictability. By encouraging all these areas, tax stability, whether the country is providing taxation at stable conditions, and ease of doing business, clearance systems, and policy predictability. Because of most of the policies are unpredictable in nature. That's why the FDIs are also getting hit. Expand infrastructure investment to attract long-term foreign capital, and managing forex and external debt. Maintain adequate forex reserves for external stability. Focus on rupee internationalization to reduce US dollar dependency in external borrowings. So not only you should focus on US dollar, on the other hand, internationalization of rupee, you should also mostly focused. And conclusion, India's balance of payments remains strong, supported by robust service exports, IT and IT enabled, remittances from different countries, and capital inflows in the form of FDI. However, global uncertainties, trade imbalances, rising repatriations, rise challenges. These are some of the challenges. A strategic focus on exports, investment climate, forex management will ensure long-term external stability and growth. So these are some of the uncertainties that India should focus, especially trade imbalances, rising repatriations, and at the same time it should focus on exports, investment climate, and forex management. So that is the discussion for third chapter under economic survey. And in this chapter mostly we had focused on reports related to India's conditions and at the same time emerging market economies and also developed countries. So the reports and the bodies which were released, these reports were very important for your prelims point of view.